The myth of a housing bust is something that has been spreading across YouTube for the past few years now, really ever since home prices shot up in 2020, fueled by the Fed stimulus and the COVID pandemic. People have been talking about how they're bound to come back down, back to 2019 levels. And this myth is persistent. You can find it almost everywhere you look. And now, while last year, moving into 2023, many people were predicting home prices would drop by 20%, by 10%. Of course, if you were here watching my videos at that time, I was predicting home prices to stay relatively flat and that we weren't going to see a crash. Of course, that is what happened. And when we take a look at the fundamentals of the housing market, what the Fed did moving into the pandemic, what they did after the pandemic, and what they're doing now, we can really understand what is happening in the housing market and why it doesn't seem like a crash in home prices is likely in the near future. So we're going to go into an article that talks about this housing bust myth. We're going to look at the Fed's data and we're going to talk about the fundamentals so you can make the best decision with your home purchase and sale. Before we get into it, my name is Liam O'Reilly. I'm a realtor in Vermont with Jerry Riley Real Estate. If you have any real estate needs, all of my contact information is in the description. And let's get into this article here. So the idea for this video came from this article, and I know I'm cutting off some of the title here with my face, but the myth of the housing bubble, right? It's time to face the facts. Sky high home prices are here to stay. And this is something that I completely agree with. And again, it has to do with the fundamentals of housing. It's not that home prices shot up since 2019, so they're bound to come down, or I'm out here saying that home prices will never come down. It's that when you look at the fundamentals, when you take a look at what's going on in the U.S. economy, the most likely scenario, in my opinion, is that home prices are going to stay stable. And so here, this author here from Business Insider, let's get his name, James Rodriguez, says here, barring a large-scale economic disaster, there's no pop in sight. And I completely agree with that, right? We need something that's going to force people to move and force people to sell. Now, what he gets wrong in this article is that he talks about building, about how we've underbuilt since 2008. But as we know, if you're somebody who's watched the channel for a while, we can't necessarily infer that we haven't built enough homes, because when you look at some other metrics here, and I've gone over this article in the past, but this chart right here, housing units in the United States versus the population. So this is a graph of the U.S. population, U.S. households, and housing units from 2001 to 2022. You can see here that dotted line of housing units has basically stayed in line with household formation, with population growth. We haven't seen housing units, the number of housing units, dip below the long-term trend, the 20-year trend of where it should be with population. So just because we've underbuilt doesn't mean that there's necessarily a shortage, or just because we've built less than we did in the past doesn't mean that doesn't mean that caused a housing shortage. Now, what really caused the housing shortage and continues to what's really the reasoning behind the current housing market that we're in is the Federal Reserve stimulus. And this is something I've talked about on the channel before, but after 2008, the Fed started purchasing mortgage-backed securities. Of course, everyone talks about the Fed funds rate, about how mortgage rates were around 0% after the pandemic and after 2008. And yes, that did stimulate housing. But another big thing that the Federal Reserve did is they started buying mortgage-backed securities after 2008 to stimulate housing. And they did it during the COVID pandemic, again, to stimulate the economy, to stimulate the housing market. And so here, we see that the Federal Reserve was buying mortgage-backed securities. They started reducing their balance sheet in about 2011 to 2013, and then they started buying again. And they've pretty much had their hand in the mortgage-backed security market ever since they started buying them in 2008. But now, this most recent trend of reducing the size of their balance sheet is, in my opinion, the main reason for the housing market that we're in. Because during the pre-pandemic, and then specifically right after the pandemic, where they were buying mortgage-backed securities like crazy, increasing their balance sheet from $1.3 trillion to $2.7 trillion. They were really stimulating that's what kept mortgage rates low. And mortgage rates, if you've ever bought a home, if you're looking to buy a home, you know that here in America, mortgage rates are on a 30-year fixed rate program. So people who bought when the Fed was simulating have locked into a low interest rate. And this is what people have deemed as the lock-in effect. And I think that's what's causing too few vacancies on the market. It's not necessarily that we've underbuilt. And it's pretty easy to think that because of how little we've built over the past 15 years here. And that's something that I have been guilty of saying on this channel is that, look, we've underbuilt, and that's the reason why there's not enough housing out there. But I think when you look deeper and you look at the charts that reflect the U.S. housing units to the U.S. population, you can see that we're really in line with historical trends for the number of housing units out there. So another explanation, or what might be a more likely explanation to what's going on and why housing units won't crash, is because people have locked into these affordable rates. They've locked into these low rates during these stimulus periods. And now the Federal Reserve is in the process of bringing the housing market back to a free market, right? The mortgage-backed security market, when they're stimulating it, when they're buying these mortgage-backed securities, that's not a free market. That's not investors coming in and dictating what the mortgage rate is. So as all the stimulus came into the economy through the U.S. government, right, the stimulus checks, all the help that was given during the pandemic, with how cheap money is, with the Federal Reserve buying mortgage-backed securities, housing was really affordable for people back then. And now, as stimulus has dried up, right, the U.S. government isn't giving any more stimulus, the housing market is returning to a free market. But the people who locked in to stimulus during this 2020 to 22 period, or even before then, again, the Federal Reserve was still buying mortgage-backed securities here, keeping interest rates lower than presumably what they would have been. Those people are still benefiting from the stimulus. Essentially, they have that stimulus locked in for 30 years by purchasing a mortgage at a low rate. And that's what's going on with our housing market and with the system that we have set up. And so when you take a look at what's going on with the people who are homeowners, with the people who have locked into these lower rates, we see that, according to this Business Insider article and some other sources that I've seen, that regular homeowners are in really good shape. They say here, and regular homeowners have never looked this good when it comes to their financial and credit health. And then right below, less than 4% of outstanding mortgages were delinquent at the end of the third quarter of last year, according to the Mortgage Bankers Association, a near record low. So not many people are defaulting on their mortgages because, again, it's essentially like the stimulus is locked in for 30 years. The people who have bought or refinanced their homes within the past 30 years are not selling. And that's what's contributing to the little vacancies that are out there on the market is people have a really affordable housing payment right now for the most part. And so if we were to see a housing crash, I think he says it right at the end of this article here, that even if the economy does take a turn, a run-of-the-mill recession probably won't be enough to topple the housing market. Things have to get so bad that banks would be forced to walk away from the mortgage lending space almost entirely, as they did during the foreclosure crisis. And what people don't know about the foreclosure crisis, right? You hear about the no income, no job loans that were given out. The reason why those products became so popular is because Fannie Mae and Freddie Mac had tightened their lending standards before, and the U.S. government, the officials in charge of the housing market, were trying to get things under control back in 2006, 2005, 2004, when home prices were shooting up. Now, people aren't trying to tighten their lending restrictions further. Now, with the Federal Reserve raising rates, that is tightening lending standards across the board, and less people can qualify for a loan because of these higher rates. But in reality, that's just the free market doing its thing. That's just the investors who are buying these mortgage-backed securities asking for the rate that they want based on the options that are available out there. So I think what's really happening is we're seeing a return to the free market. And so I think the likely outcomes for the housing market moving into the future with these rates is that we'd see rates stay stable for an extended period of time, for years and years on end, if we see the housing market, specifically the mortgage market, return to a free market. If that is the case, then I think, I don't think a major crash is coming. I think we're going to see stable prices if the Federal Reserve keeps their hands out of the mortgage-backed security market. And as, inflation continues naturally across the US. I mean, who knows exactly how hot it's going to be in the upcoming years, but I think inflation is going to continue as the US government and our officials continue to increase the monetary supply out there. Then, eventually people's incomes will catch up to where home prices are. And then maybe 20, 25, 15 years down the road, as these mortgages that were locked in recent years start to come to maturity, then, the housing market will be back in an affordable balance. I think that's one scenario that we could see happen. What I think is more likely is that when we enter into a recession, regardless of the severity of the recession, but especially if it's a severe recession, we're going to see the Federal Reserve jump right back into the housing market. We're going to see them buy mortgage-backed securities. We're going to see them drop the Fed funds rate down to zero if a recession hits. And if that does happen, then housing is going to become more affordable. And we're going to basically restart this cycle of the Federal Reserve stimulating housing, and it's going to be reset for another 30 years. And so I think that's more likely, because once they've dipped their toes into buying these mortgage-backed securities, it's tough for them to get out of the housing market, to stop doing that. But we'll see what happens moving into the future. So anyway, Liam O'Reilly, Vermont Economic Realtor. Let me know what you think of this video. I hope you got something useful out of it. This is what I see is going on in the housing market right now. I blame the current unaffordability on the Federal Reserve's stimulus from 2008 up to today. And I think that's what's causing a lot of pain for home buyers and sellers out there who want to buy a home but can't afford, or want to sell a home and can't afford to move anywhere else. So leave me a comment. Let me know what you think. Other than that, I'll see you in the next video.